How do sunspots link to stock market performance historically? Imagine a giant sun in the sky, pulsing with dark spots that come and go every few years. These dark patches are called sunspots, and they have a surprising connection to how our economies and stock markets behave over time. For over a century, scientists and financial experts have looked at patterns between sunspot activity and major market events. It turns out that when sunspots are active, the stock market often reacts in predictable ways, especially during certain phases of the solar cycle. Sunspot cycles typically last about 11 years, but they can range from 9 to 14 years. During these cycles, the number of sunspots rises and falls, creating peaks and troughs called solar maxima and minima. Researchers have found that stock market recoveries tend to happen when sunspot activity is low, during the solar minimum. For example, after the stock market crash of 1929, the recovery began around 1933 when sunspots were at a low point. Similarly, after the financial crisis of 2008, the market started bouncing back in 2009, coinciding with a period of low solar activity. Looking at data from the late 1800s to the early 21st century, the Dow Jones Industrial Average, which tracks 30 large companies in the United States, shows that major market bottoms often align with sunspot lows. Conversely, market peaks sometimes occur when sunspot activity is high, especially during solar maxima. The dot-com bubble in 2000, for example, reached its peak during a solar cycle peak. The housing market crash in 2007 and 2008 also happened during a period of increased solar activity. Recent studies from 2015 to 2020 support this pattern, especially with technology stocks like the Nasdaq Composite. These indices tend to show stronger negative correlations with sunspot numbers. When solar activity peaks, technology stocks often face declines, possibly because geomagnetic storms caused by solar maxima can disrupt satellite communications and power grids. These disruptions can influence investor confidence and behavior, leading to market downturns. From a long-term investment point of view, understanding these cycles can be useful, but they are not perfect timing tools. For example, in 1994, a solar minimum did not lead to a market bottom, showing that other factors also influence stock prices. Still, for investors with a multi-year horizon, paying attention to solar cycles might add an extra layer of insight. Commodities like cattle futures have shown even stronger links to sunspot activity, with some studies revealing a 24% correlation over 110 years. The way solar activity might influence markets is thought to happen through several channels. Geomagnetic storms during solar maxima can interfere with satellite systems and electrical grids, which are vital for modern financial markets. Additionally, changes in atmospheric conditions caused by solar cycles could affect human mood and decision-making, influencing investor psychology. Looking ahead, NASA predicts that solar activity will peak between January 2024 and January 2026. If past patterns hold, this could mean potential market tops during this period. However, these forecasts are not foolproof, and many other factors influence market movements. While sunspot activity cannot be relied upon as a precise timing tool, it offers an interesting perspective on how natural phenomena can impact economic systems. For long-term investors, keeping an eye on solar cycles might help in understanding broader market trends and managing risk over time.